So, but you said you're back drumming because Eric, I ran into our mutual friend Mark Cunningham
Hmm.
at the Acuma conference, and he, of course, as he usually does, put on a nice guitar display. That was actually the music, Rob. Was it our session where the music in the background started blaring like halfway through? I forget if yeah, it was when I was in with you. That was Mark
On the
Cunningham.
other side of the wall.
Yeah, jamming out. But he said he's starting, and he said he mentioned you as somebody he either reached out to already or wanted to reach out to. He's going to start a band of all mortgage professionals.
He
You
did
know,
reach out yesterday, as a matter of fact, and
yeah, to
said,
play, at these, not for pay or anything, but just, as like entertainment.
"Oh, I only do it with pay and writers. You got to have removal
Yeah.
of brown M&Ms, a sandwich with rye on the bottom and wheat on top. Otherwise, I don't play."
But he had it all mapped out. He named like five or six, people in the mortgage industry that were really talented musicians, and he said he wanted to galvanize it together and and start playing regularly. I said that's a great idea. Mortgage conferences are always looking for free or cheap entertainment, and it would have some added appeal with everybody being in the industry.
Yeah, it'd be fun. I'd like to see how it comes together. But yeah, he did mention it to me. We just don't know who everyone would be. But what's cool about that is if it does happen, there's ways that you can rehearse or jam remotely. They have these things called
Mm.
Jam Hub where you basically dial in and you get your level set of what you're going to have, and then it's basically like you're there in the same room, but you have these inputs that go through a software program where you can control the volume, control the effects you have, and all sorts of stuff. So if anyone's
Now,
going to figure it
is
out, it's
that a
going to be
paid
Mark.
service?
When I used it, it was not. It was a module, but now I believe it's a paid service. So maybe
Because
Max Weinberg's doing that.
I would think all these computer programmers have to make money somehow, right?
Yeah, right.
All right, here
All
we
right,
are.
let's go ahead and get into it. I'm Rich Swerbinsky with Onward and Upward Consulting. This is the big picture. Thank you for joining us, as always, on the live version Thursdays at 3 p.m. Eastern. And as always, joined by my esteemed colleague and co-host, Rob Chrisman. Rob, good to see you. And I know where you are, but tell the masses where you're at today. Everybody's always curious.
Uh, no, look there, Ira chipping in with the cornball humor already. As long as the band has the right notes. I was going to ask if they were going to play were the blues, but anyway, I am in a little place called Truckee, California, north of Lake Tahoe. A
Which
lot
I
of
which I had to Google, but it sounds and looks like a beautiful area, very
nice
seasonal,
place.
Southern
Yeah,
California. Yeah.
it's on Highway 80, which goes from Sacramento to Maryland. So
Truckee, Truckee, Truckee,
Truckee
Cal.
was named after a Indian chief.
Okay, makes sense.
I,
So
I hope he didn't own slaves, 200 years ago. Otherwise, the town would have to change its name, right?
to the Guardians, right? Go Guardians, by the
Yeah.
way, 6:08 p.m. Eastern today. So fighting for their lives. But and this week, really, really pleased to a special guest to the show this week, the president of FormFree, Eric Lapin. Eric, great to see you, buddy, and thanks for joining us.
Yeah, thanks, Rich. Thanks, Rob. Back to Ira's comment there. Just so you know, Rob emailed last night and asked if music was going to be played with an A sharp or a B flat key when he was watching the Boston concert. And it's for those of you that, I'm sure Ira knows this, but that's it's the same key. It's there's no difference with that. So that was starting off with the clever humor on the music.
Always the humor. So, but let's go ahead and get into it. And Rob, I don't know where to start today, honestly. We've got, conspiracy theories about man-made hurricanes. We got the homeowners insurance issue. The election's 26 days away. CPI this morning, core CPI came in a little hot. Anything in there that tickles your fancy to get this thing going today?
No, other than, and I've talked about this with others. I I'm just deluged by texts every day now. I don't know. I don't know where they're coming from. The election, you know, hi, this is Bernie Sanders. Hi, this is Ted Cruz. Hi, this, it's like, pray for Elon Musk. Uh, I just bizarre texts that are, it's not good. It's not a good situation. So yeah, the election finally less than a month away, but still a good 3 weeks, right? Um, and even then, I don't think the morning after in the past, and I'm not talking about the drug, but the morning after you used to be able to look at the headlines in your newspaper that was delivered in your on your on your driveway, or turn on the TV and there would be an actual outcome. We may not know this outcome for weeks, right? Unless it's some kind of landslide. And even then, you know, no matter win or lose, the lawsuits will start. I don't know. It's crazy. It's crazy time.
It's going to be crazy. It's very close. I looked at the betting odds right before we went live here. Former President Trump now 55% chance, according to the most important markets, the betting markets, if you actually want to wager your own money. So a very, very slight favorite, but the poll's so close in all the battleground states that really matter. There's about 8 of them that matter. And yeah, and to your point, both campaigns increasingly just increasing aptitude at getting a hold of people with their messages against our will most times. But the onslaught begins. Ohio's not even a close state this year. Trump's up like 10 points. I've seen so many political ads. I can't even imagine what it's like in one of these states where it's close. It's got to be crazy. So
And how important is do you believe affordable housing and some of the things that we've been talking about for the last month with what Harris said and what Trump said on their, what they're going to do is that move that number, would you say, since middle of September?
well, I think, Trump was winning big when Biden was still in the race, and then Harris got that massive boost, when she came on. And it feels like Trump is now, kind of is eked back into a slight lead if you look at all the, most important polls that are nonpartisan, real clear politics, the average polls, the ones I kind of look at. But it's still a lot of time left, and it really is a coin flip right now. I don't, Harris has put a lot out there about housing, and I guess we can kind of dive into that. Trump hasn't really put anything, not too much out there. He's really just more alluded to, fixing immigration and fixing inflation will fix the housing problems in America, which certainly has merit. But Harris has put a lot out there. Any thoughts, Eric, on just what you've seen from the candidates on their housing policies or lack thereof?
Eric, and at some point we'll talk about FormFree, but go ahead.
Yeah. No, I think some of, that $100 million in community grants that's been brought up. I mean, that'll definitely remove some of the barriers, I think. There's two ways to look at that $25,000 tax credit as well. Again, I think there's positives and negatives to both. But yeah, like you said, on the other side, with focus on immigration, the housing solution will basically work itself out because it'll help bring more inventory back in. That was the thought process behind that comment that was made, but and looking at population growth. But I don't know. I think I believe Vice President Harris is looking at 3 million new housing units over the next 4 years. It's a good thought. A lot of things go into that right now. As we were talking pre-recording here, one of the most important things to look at is housing, but the affordability. But a year ago, were we really talking a lot about the climate and where that's coming in, and the insurance premiums and not is it going up 20, 30, 40, 50%, 100 and 150% in some areas. And now after the Milton yesterday, and our current desirable areas, they're going to be the future desirable areas when people want to move for whatever reason. I don't know. It's a lot to take in.
It's a valid point. I mean, homeowners insurance rates before these hurricanes were, starting to become a really big topic in the industry. Just, obviously not helping the overall affordability issue. And, certainly the latest climate related developments aren't going to bring insurance rates down. But it's just, I mean, Rob, I'm sure it's something you hear about a lot more. I mean, it's something we never really heard about ever in this industry was homeowners insurance premiums. But you know, this last year or so, I know we've talked about it on the show, but it's emerging into, you know, one of the bigger issues for consumers, certainly that want to get into the housing market, but even lenders, no, Rob?
Well, whether you're talking about insurance or whether you're talking about additional homes being built, I remain unconvinced that the federal government can really do a lot in either one of those. You talk about housing, it's so much of it's local. You know, I don't want 50 units going in behind me here. 50 units of affordable housing. So, and in many areas you run up against water issues, traffic issues, and places that are undesirable to live in. I mean, maybe no one wants to live in West Texas. So you can build a lot of houses there, but dot, dot, dot. And then it's the whole permitting process, and then not in my backyard and labor. And I mean, it's just, there's no easy fix to flip a switch and suddenly there's 3 million new houses somewhere. And then with regard to insurance, you know, it's such a state issue with regard to state insurance commissioners everywhere you go. And the insurance companies are, you know, they're not happy with the way things have gone. And you have places that don't feel like they should foot the bill for whether it's a you know, an oceanside home sliding into the ocean in California, or somebody who built a home under sea level in New Orleans and a hurricane comes through, or the damage that we're seeing in Florida or North Carolina. It's like people in Minnesota or Wyoming or Nevada are saying, why should we pay for that stuff? So the insurance companies are stuck in the middle and there's no easy solution there. And once again, I remain unconvinced that the federal government can step in and tell every state's insurance commissioner, okay, here's what you're going to do. So complicated issues. But getting back to FormFree, Eric, how long have you run FormFree, the mortgage side?
Been here over 2.5 years. So February of 22.
And you're riding down the elevator with somebody. You've got 15 floors to describe what FormFree does.
Yeah.
Go.
Empowering the consumer with their own data and matching them with lenders that have loan parameters and programs to fit what that consumer's looking for. So the big difference here is we're looking at one-to-one relationship between a consumer and between a lender, removing that friction of providing documents, removing that friction of getting contacted multiple times by text, email, phone calls from the current way of how lenders find consumers. And, you know, lastly, we have it to where it's utilizing open banking, which is really falls under the CFPB Dodd-Frank Rule 1033, which is taking effect January of 25. So, you know,
can you explain that? What do you mean open banking?
Yeah, it's basically connections of you know, transaction data and banking accounts that consumers provide the permission to have their accounts reviewed by any sort of lender or payment company. And out of that, they are offered services and products that would benefit them. The big difference is that you have an open banking community that, I mean, there's aggregators to aggregate over, you know, 16,000 financial institutions, over 45 to 48,000 connections. And when you work with these types of groups, you're able to, upon the consent of the consumer, take a view into that consumer's cash flow and take a look at other types of events that happen in their life, other things that you can perceive and take out of the bank account. You can look at rent histories. You can see how someone's getting paid on there. You can see all sorts of things and glean that from there. And the key here is it's what's called source data, which is really a big topic in our industry of analytics and intelligence. If it's off of source data and it's also consumer permission, there's a lot you can do with that. And we're really just scratching the surface of the top of the funnel, working with consumers and working them all the way down through underwriting, processing, servicing, onboarding, and all the way through the secondary market.
In layman's terms, Eric, explain, the rule issued by the CFPB that goes into effect in January. If you could just, give the listeners just a little insight as to like exactly what that entails, what that changes.
I mean, there's a couple things that it does. So it's the CFPB rule 1033. It allows the data holder to really have portability of their own data. So we as consumers can decide where that data goes, who's it shared with, how long is it shared, and for what purpose. So there's specific use cases that it can be used for, whereas today we see consumers' data being used in areas that it shouldn't be. It's sold all over the place. It's caused a lot of issues, a lot of data breaches. If there's several factors that determine who handles a loss if there's any sort of data breach. But in this case, when you're actually looking at the data that a consumer provides, it doesn't go everywhere. Whereas today we live in a world where our data is being marketed to us through social platforms and Google, Meta, Instagram, and anywhere we go, there's some sort of algorithm letting us know what they think we want to see, and we didn't know our data was being used for that.
The political texts, right? I mean, that's a perfect example.
Oh yeah. Yeah. So, I mean, it's really just this rule came about October of 2023 by the CFPB, and they announced this proposed rulemaking to accelerate a shift towards open banking that gives consumers more control over their data, and it protects it against companies from misuse of the data.
And that's during the processing of a loan, or is it every day?
It's anytime financial data is going to be used for anything. It could be for payments reasons. It can be for consumer loan, mortgage loan, anytime it's going to be utilized.
So basically the rule would cover anytime any consumer submits or allows access to personal financial data on any kind of financial product, there will now be specific guardrails on what those companies that collect that data can use it for, who they can share it with, and so on and so forth. No?
That's right. And it's, when the rule takes effect, there's going to be certain time frame that these financial institutions, based on their asset size, have to be compliant. So it's actually starting at the top. So if it's under 500 billion asset organizations, you have 6-month post rulemaking. 50 billion to 500 billion is 12 months post rulemaking, and then under 850 million is 48 months. So the key here is just to make sure that there's availability for the especially in our industry, for the lenders to make sure that that they're keeping costs down from doing something like this. So, the talk with this in our industry is lenders may face higher costs due to upgrading the systems. They have to enhance data security, ensure regulatory compliance. There's a lot that comes with that. And, as we know, with the manufacturing costs as it is in the mortgage industry, it's just another percentage to add to there on it. But, the positives here is privacy concerns, data sharing, identity theft, all tie in together. And we're going to see a lot of reduction, I believe, in identity theft when we have consumers controlling their data via their own wallet, sharing it where and when they want, when they're ready to buy. So it's a good method, I believe, and understanding the privacy policies is going to be important.
Go ahead, Rich.
I was just going to ask real quick, how other countries, are we like ahead of the curve on this, behind the curve? How have other countries and economies handled it? It's a huge issue. It wasn't that long ago. It's probably, what, 10, 12 years ago. We're, still a little trepidation and, giving your credit card number online. Now I'll give it honestly to anybody. It just becomes so woven into our lives. But how does America, where we're at with all this, compare to other major countries? Any idea?
We're behind. Yeah, we're behind, and mortgage industry is behind, say, the payment industry. So, I mean, payment APIs, 87% of consumers are connecting to some sort of open banking powered app. That's a pretty big number. So it's
how would I do that? How would I know if I was or not?
Think about any app that you're on
Venmo,
today. Yeah, that's open banking. I mean, it's a persistent
Uber.
connection in there. Yeah, anytime you're going to be connecting anything that's going to have bank account information or credit card information, but it's more so, if you were familiar, the first one I got on was Mint years ago, and it was more of a budgeting tool app. And I utilized it because I wanted to see, what was I spending? How was I using it? I'm a Credit Karma user. I like Credit Karma. They do a great job of just loan offers that I can look at. Credit card transfers, if I had balances that I want to transfer, where are the best ones to go to. So it does a lot of the research and analytics for you as a customer. And for that, I mean, that information is then it's obviously sold to some sort of a lead generator, but at least it's, me being interested on how I can make my experience better.
And how would a loan officer, if senior management, let's say they visit with you at some conference or something and they learn about it, and senior management is thinking about explaining FormFree and the advantages to the rank and file loan officers or account executives, regional managers, what are the highlights of what they tell their staff about FormFree?
So if you look at the top, we call it the top of the funnel or the pre-application, right? We always deal with POS and LOS. We're used to that, but go further up from that. So imagine as a consumer, if you are, you're looking for a loan, you're not sure what you can get, you don't know how you can get it, but there's a little trepidation because in the past, at least myself, I just wanted to know what a rate was, or I wanted to know how much down do I really need. Most people still don't know that they don't have to have 20% down. A lot of people don't understand mortgage insurance. They don't know what the purpose of that is. It's just something the average home buyer doesn't know. And in this case, we ask questions on the consumer side, through our marketing strategies that allows the consumer to answer questions on what kind of loan are they looking for, what state are they looking in, how much do they want, how much do you want, really is the question. And then, from there, we have that information pulled. The consumer's asked to link their bank account. We have privacy statements. We have the anything that they need to know of how their data is being used. And that information is then linked to the bank, or we pull the information from the linked bank account. And the intelligence that we're using on there is what we call RICI, and that is the Residual Income Knowledge Index. It's a little bit different than what's out there and what we read about because we're not using generative AI. And that's been the big talk for the last year and a half. There's a lot of great uses for generative AI. We've all talked about those, from the loan officer chatbot to marketing to answering generic questions. But what we're utilizing artificial intelligence for is more on the linguistic side and mathematically deterministic approach. So we're looking at these linked bank accounts and all the transaction data and determining what's the cash flow, what's the discretionary income, are they trending up or down? Is this a person that should be getting this loan, or is it someone that may have a high credit score where you can get that loan sold to an investor? But if I'm a seller servicer and I'm servicing my own loans, is this a loan that I want to do where someone may have a 770, but the line utilizations are maxed out on the credit cards? And we know that the country's at 1.2 trillion in consumer debt and growing, the highest it's ever been. So this really helps the consumer and the lender figure out, is this a loan that should happen? Because the scoring system that we have today is very helpful on looking at historical handling of the debt. Whereas looking at it through what we're doing here, it says based on cash flow and what you have discretionary, here's what your borrowing power is. And we provide that borrowing power. We also have a relationship with credit provider where we are also displaying credit score ranges. So these medallions, we call them, come with the many of them come with the linked bank accounts. Very high percentage come with the credit score ranges. And then we have a report that shows the lender what they're going to be looking at with the consumer as they begin looking at matching. And then just to tie this up for you, the matching happens in an exchange that we call the FFX, or the FormFree exchange. And the FormFree exchange is the lender, it's just lender view only. They utilize filters to find these potential borrowers that are looking for loans that meet the buy box of the lender or the loan parameters of loans that they have a good secondary market exit for. And tie that into the Rule 1033 of consumer controlling their data, sharing it for when they want, how they want. Lenders are going to provide offers. The consumer decides which ones they want to go with. And once that lender information is accepted by me as the consumer, then my identity, age, sex, gender, all that goes with it. So we're removing the bias of it way up top before it even starts going through a 1003 application.
Interesting. This is The Big Picture. I'm Rich Swerbinsky with Onward and Upward Consulting, joined as always by Rob Chrisman. This week, the president of FormFree, Eric Lapin. And Eric, a lot of stuff I want to dig deeper into there. I mean, FICO, really, I think we can all agree, is still a useful data point, but kind of like the end all be all, for like the GSEs and, especially under the government thumb, you would think that, they would want to be very proactive and, utilizing every tool and all the data that they can and that is available to help make good decisions on, agency guidelines and what kind of loans they're going to buy. You guys are right at the heart of this with FormFree. Have there been any discuss just with FHFA? I know they have been seeking and inquiring about industry input on FICO versus ulterior scoring models, but it sounds like you're kind of alluding to is the power of all this data that you're collecting. It's now going to be more policed and guardrailed. It's very powerful underwriting decision-making criteria. Can you see a world where like the GSEs or, other major secondary market players would be, incorporating data sets a provider like FormFree could provide them on a loan level basis to help make decisions on things?
Yeah, we see that definitely down the road. I mean, there's different strategies being discussed and worked on. Right now, we figured let's tackle the consumer approach of they want a better experience. They don't want to be notified 100 times over by text and email with all these robocalls of looking for a loan. And then let's also make sure that the lender side is getting someone who has high intent, utilizing source data before they even match up with this consumer, so they don't have to spend a lot of time pre-underwriting and pre-processing a loan. It's very, very costly, as we know, especially for a lot of the companies. I see a difference coming down the line with certain lenders that the loan origination structure we see today moves more towards a loan advisor. And I think there's going to be certain channels that have a loan advisor, and then you're going to have your traditional originators that have their home builders and they have their real estate connections. But then you're going to have others that are just very well equipped and educated in the loan process, and they're going to be paid differently by these lenders, I believe, and because a lot of this data can be served up front. So down the road, we're really just tackling ability to pay through an alternative method. And to answer your question, yeah, I mean, we're, working with, one of the GSEs on, let's look at loan performance. And we're not saying to compare to what the credit scoring is today, because it's a different corpus of data. You can't compare historical data with this, banking account information. What we're saying is that there may be some people that are possibly being mispriced in our securitizations right now. And, it may be that the capital markets are paying higher yield spreads for loans that maybe they shouldn't be. And that only comes through loan performance over a certain amount of time. So, if something's paying at a 103, 104 today for a certain score range, maybe it should only have a 102, because these loans have a home. It's just that if you misprice the loan, then it's not a bad loan. It was just a mispriced loan. It's just not priced for the risk effectively. The other thing is, eventually see down the road that, we've seen great response and help from having the scoring system that we've had for a while. I think we still keep that. There's a lot of usefulness to that. Understanding how someone handles a debt is a good predictor. But imagine marrying that up with also looking at today and cash flow, and you bring those two together, and now you have a very open aperture of a very clear lens of someone's ability to pay based on today. And then you could better model in the future, because the way that we're looking at these loans, I mean, bring back our climate discussion we had earlier. If we're doing 30-year loans and we're doing those on homes that are in areas that that property may not be there because the risk that's coming out from these climate risk providers are saying, you know, if the water rises 1-2 feet by X amount of years in the next 15, 30 years, well, then you have a much higher percentage of your collateral not being there. So it goes back to the 5 C's, right, of lending. And, you know, we're really just focused on this one. But yeah, down the road, we see this being used as a potential underwriting tool. And we actually have a partner that has a portfolio that is going to be utilizing our Ricky, still pulling a score, but wants to make decisions off of cash flow today and hold it in the portfolio and season that and see how the performance is. And I think more and more companies that do that or have the ability to do that allows us to then get with regulators and rating agencies and the capital markets. And there may be an opportunity for another type of security out there for something like this.
Yeah, and that's where I was going next is, yeah, I mean, you could see a world where, you know, you've either got private label securities or securities that fall under the GSE purview that, yeah, kind of have their own classification with pay ups or maybe not high as pay ups and certain, you know, added to climate risk, a lot of new challenges for mortgage lending leaders to navigate as we get set to put a wrap on 24 and move into 25 here.
Yeah. I mean, there's all different sorts of indices being created right now. I mean, if you guys are familiar with the Waffle House Index that I've been reading about lately, just with storms.
No.
Yeah, look it up. It's developed by FEMA, but it's the Waffle House Index is a metrics that gauges the severity of storms, especially in the areas where there's a lot of tropical storms and hurricanes. But if the local Waffle House closes down and, you know, only serves a half menu, then it's not going to be a good thing because of storm intensity. But if the Waffle House is actually closed, they're saying brace yourself because it's going to get bad. And they actually closed many of them in Southwest Florida yesterday, which they rarely do. So it's a real thing. But
Interesting.
yeah,
I personally use the Rob Krisman Airport Parking Lot Index. You know, it's but
The Waffle House Index.
yeah. So I mean, if we look at that and we look at, you know, a lot of the things, there's a lot of things that we look at a lot differently than we think about. Back to the insurance premiums, the affordability of home ownership, even the people that own homes now that look to consolidate debt. Certain areas we're seeing the prices of the home or the value of the home goes down. It's also in obviously in Texas and Louisiana and Florida and the Carolinas. I don't think any of us thought it would be like this, even when we were looking at predictions 6 to 12 months ago. So how important is it now to really look at the PITI of a borrower? We're already maxing the highest percentage ever of consumers that are squeaking in these debt ratio requirements. And now you want to throw another insurance premium on there that we know is not going to go away. And I don't think we even have enough information now to know what that'll be in the next 12, 24 months.
Yeah, I keep writing about it, Eric. You know, catastrophes, disasters, insurance, and the used to be whenever I would write about FEMA and so forth and the disasters, I would receive emails from people, usually the same people, saying, "Rod, why are you even talking about this? There aren't any changes that are going on with regard to anything." I won't get into the the nitty gritty of some of the letters, but anyway, and I would always write back, you know, I don't care if you believe in climate change or not. I don't care if you believe in man-made versus natural climate change. I don't care. But if the investor cares and the insurance company cares, and you know, the MI company cares, then it's going to impact your borrower.
100%.
Get over it.
It's going to impacts the borrower and it impacts our business as a whole. I think, you know, I had a great conversation with someone at Housing Wire last week, and we all have our spots in our business, right? We all have our certain things we do. You're a lender, you're the tech space, you're collateral focused, you're alternative credit focused, you're whatever you are.
I'm usually collateral damage, but go on.
Yeah. you have to keep up and really dig in and learn what's happening, because it's happening fast. And for those that keep up with it, and I think everyone on this call and listening in, there's, your report every day is great. I mean, there's so much information to take in, and now you add this into it. Again, it doesn't matter if you believe in the weather changes. It doesn't matter who's doing it. Like Rich said on the onset of the call, if whatever the reasons are, it's affecting our industry. And you've got multiple companies that are really focused on mortgage. You've got CoreLogic, First Street, Moody's, Jupiter. They're all different groups that have really specialized in looking at this. And I was reading an article, I think it was First Street said that 57 banks had a total of 627 billion in real estate loans exposed to material financial risk due to climate. So if you tie in this piece to the not understanding your borrower's ability to pay by looking at other methods, I think we're becoming an industry more and more that we have to open up the as many black boxes as we can, collaborate with companies that are in our industry that have a specialty, that do a good job, put solutions together that everyone can utilize and have a unified data set that's standard, and source data as much as possible. That limits the risk. And then lastly, most importantly, reduce the identity theft and fraud and privacy risks that we keep seeing over and over and growing year over year. I thought it would be less, but it's getting worse. We've got to stop that as well. And that's one of the things that we look at FormFree with the information that we have. Also we talk about what's called self-sovereign financial identity that we want to work on down the road. So again, there's a lot of things that we can do. Right now, we're just focused on ability to pay for consumers before they even go down the process. So I'm positive with a lot of the discussions and meetings I've had with companies out there that are focused on these kind of things. And I remember really concerned about ability to pay being different, the way we review collateral different, capital markets, the way they pay up for loans needs to possibly be ratified, or some changes have to happen there. The climate piece was just boggling to me, but I was at a AmeriCatalyst conference 5 years ago when it was brought up. Tony Moss puts that conference on. It's great. And, everything those people on the stage said is coming true. And we got to do something about all of this.
Yeah. Once again, it doesn't matter whether you believe it or not. It's everybody else does, and it does impact borrowers. One of the interesting things that I see happening, not only with regard to this, but just in general, I mean, to your point, the granularity of the information that's out there is not going down; it's increasing. And I was talking to a fellow named Kingsley Greenland. You know Kingsley, Eric?
Know the name.
Verisk. Anyway, spent some time with him, and he was saying the insurance industry is much farther along in looking at data than mortgage-backed security investors or the lending industry in general, because the insurance companies, obviously their livelihoods at risk, and they will have different premiums based on, for example, a condominium's location within the complex, whereas a lender or a buyer of servicing will just say, well, yeah, we're buying servicing in Florida, bring it on in, or we're buying servicing in Missouri. But the insurance companies are looking at it based on, zip code, based on complex, based on historical weather records, et cetera, et cetera. And that's how they analyze risk. And so Kingsley was saying, it's just a matter of time until servicing buyers and mortgage-backed security owners and lenders accept or look at things the way insurance companies do now. So we're heading in that direction.
We are. Yeah. And I think even though, insurance companies are raising premiums or getting out of the business of property or P&C side of it, how does that affect the pool insurance for the loans, and how does that affect the pricing all the way down to the consumer level, where in reality, if we use some of the tools, meaning the data sources and the analytics that can reduce the cost that we talk about, use that up front, that actually flows all the way through the process, it still should be uh, a cheaper manufacturing process, even with this added insurance. So maybe that's one reason it pushes it. The other thing is when pre-crisis, when I was working at a top global lender, our division was the fixed income side. And we, like most lenders back in that time, there were certain spots in California and Florida that, lending just didn't happen. It didn't happen, or it had a 50 basis point bump for being in a certain zip code and another 100 for being a high-rise condo or a condotel, like all these kind of things that go into the risk. They were still desirable areas where people wanted to live, move, or have a second home. But I think with what we're seeing here in the last few months, desirability may change. Maybe this is the part of people have been talking about a black swan event. We don't know what's going to happen. Well, what about the people that came from California and the Northeast and Midwest moving to the Southeast because they want the weather? It's beautiful, it's cheaper, the taxes are less. But how many times, I mean, there's probably going to be an index created that, or some sort of index that says, all right, well, I'm a institutional or an individual landlord that owns properties. My tenant had to vacate 5 times in the last year and a half. They're done. They're moving back, and I can't fill this thing as quickly as I used to. And then you have others that are, the insurance just gets too much, where they're like, I'm going to become, they were called halfbackers. They would move from the Northeast, Midwest, California to Florida, and then they move half back to the Carolinas. That's how we got busy here in Charleston. And then now they're calling them fullbacks. So now they're like, I'm going to go back to Ohio, or I'm going to go back to Jersey, or I'm going to go back to Michigan because I'll deal with the winters. I'm just sick of this, these hurricanes and the flooding. And yeah, it's different. We didn't see it getting this bad, is my point. And I think there might be desirability changes, and days on market for homes and typical areas that were desirable may not be as desirable anymore.
Yeah, I wrote about it. I think it was yesterday. I don't think it was today. I think it was yesterday in my commentary in the opening paragraph, talking about how institutional buyers are now shying away from Florida. And the homeowners assessments are, north of $100,000. And that's basically coming right out of the value of some of these units, so that the appreciation that that market has seen recently has vanished. And individuals and institutions are having some trouble finding buyers at this point, just because of the issues that we're talking about. So that's interesting. I want to ask Rich, what happened to the fullback position?
Kyle Juszczyk, your 49ers, he's still a pretty good one. It does seem like
still
it's kind of
exist?
I mean, with some offenses, Kyle Shanahan and his disciples, but not, not too much of it anymore in the NFL. But I never heard those terms, but it makes sense, the halfbacker, because so many Ohioans
Yeah.
to Florida. I mean, it's like the joke in Ohio. Oh, all right, yeah, you're 50. All right, time to move to Florida. You go down there, you see a lot of tribe hats, a lot of brown stuff. And then, but a lot, yeah, halfback, move to the Carolinas. But what you're saying, Eric, the new trend could be Ohio's the new hotspot.
Who would have thought?
There's
I
Catch
mean,
the
I've
wave.
always wanted to live in
4 more
Cleveland.
hurricanes in Ohio. It starts to look better and better with each one. All right.
Right.
Yeah, it'll
Or,
become there's some climate change in there, Rich, and it'll become balmy in January.
I'll tell you what, I'm looking outside right now at sunny skies, 64 degrees. I mean, it is. I was talking with Eric pre-show. I mean, it's gorgeous in Ohio, like September, October, November, even. I mean, it really is. It's got to deal with February and in parts of January.
Winsburg, catch the wave.
That's right. Exactly. So, well, good stuff and great conversation. Something that we've started to talk more about, climate risk, open banking, topics that are certainly emerging in our industry and topics that leaders of mortgage lending institutions, and for that matter, loan officers and people that interact with consumers on a daily basis really have to, be more informed about. Any parting advice for those that interact with customers on, maybe just some easy ways, Eric, to kind of translate some of the salient points of these issues to people they're talking with?
No, I think what it is stay active in your local and national associations, attend the pertinent conferences. And then, there's also a lot of great webinars and groups that are being put together for the purpose of, all right, there's a lot of information getting thrown at me. Here's what my needs are. Can you help me? And I'll help you with what I know. I think this is making us better, not as just a society, but in an industry. Got to collaborate more, got to help each other. If we don't, things can get out of hand pretty quickly. And I think all of us want to make sure that we're doing right by the consumer and right by our constituents here to make sure that we, keep our business thriving and just getting better.
Because they're different issues than like dealing with an FDIC audit or, trying to drive down the cost of loan production. I mean, these are much more complex issues that really require, to your point, more true, genuine networking, really peeling back the layers of the onion.
There are. I mean, there's just 2 weeks ago, I was back-to-back calls with some lenders, and I like to ask questions, what's your cost to manufacture? Some of them are still 10, 11, 12. And then one gentleman said, I'm under 3,500. I'm like, really? He's like, "Well, but I'm not going to say how I do it, But the long and short of it is understanding the changes that are happening, embrace them, research them, learn about them, and implement them. And overall, you're not going to get hurt by something that's bringing more efficiency, utilizing source data where consumers are driving the boat more, because that's where things are going.
Good stuff and
Yeah.
great information. And yeah, Eric, really, really appreciate you
Thanks,
coming
guys.
on. And just
Thank you.
speaking very intelligently, some really critical issues, and all the best to you running FormFree, which was a B2B company only, and now you guys are in the consumer business. So all kinds of new exciting stuff for FormFree as well.
Well, we're B2B. It's really all of us. I mean, Brent, the CEO and founder, is still involved and very instrumental in some of the stuff that we're doing from a marketing standpoint and keeping the vision. And, we brought in some technology, architect, engineer people that have been in other industries and brought a wealth of knowledge of efficiencies that didn't see prior. And it's at many companies in mortgage. It's just good to have some fresh looks and eyes on that. But before we go, I just want to thank Rob and you, Rich, for the reach out to get on the show, and the stumper of the picture of Rob sending me the famous drummer Max Weinberg that he just met with. Was that just met with, or when did you get that picture?
I didn't meet with him. That's a story I can tell you over a glass of Chablis in Denver.
All right, sounds good.
Well, good stuff.
All right, guys. Yeah, thank you.
Rob Chrisman and Eric Lapin from FormFree, and to all you that join us on the live, if you're listening to this on podcast or watching on YouTube, we do the show live every Thursday at 3 p.m. Eastern. You can go to chrismancommentary.com to get registered for that. And next Thursday, Mark Calabria coming on. So looking forward to getting his thoughts on the GSEs and what the future could hold for them, regardless of which side wins the election coming up in 26 days, mercifully. So, but
all right, thanks, Eric.
All right, thanks, guys. We'll see you next Thursday at 3. Thanks again, Eric.
All right, bye-bye.
All right, take care, everyone.